It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hey, everybody, it's Mark Yegge. Welcome to another edition of the Wealth Architect Podcast. Glad you're here, and so glad that we have this great guest today. We have today the president of Castle Asset Management. It's a fiduciary advisory firm known for holistic macroeconomic planning. And our guest today has over 40 years of experience, kind of like me in some regards. He's a contrarian voice in finance, exposing Wall Street's hidden risks and advocating for safer, long-term income strategies. We love income strategies here. He's the best-selling author of The Pirates of Manhattan, and he's been featured in major media and financial documentaries. His research-backed, client-first approach helps individuals take control of their financial future with clarity, truth, and transparency. Our guest today is Barry Dyke. Barry, welcome.
Mark, thank you so much for having me. It's wonderful to talk to a like-minded voice who needs to help people, who wants to help show people how to get more income in retirement. Because, as you know, and I gave you the statistics, it's going to be in my next book. But we're the #1 economy in the world, Mark. We are in the top 30 in terms of the top 30. Now we're the largest economy in the world. Okay.
Yep.
US is #1, China's #2, Germany's 3, Japan's 4. Where do you think the US stands as a country as for preparedness for retirement in the top 30? Where do you think the US stands?
27?
Damn close, 29.
29? Wow.
Yeah,
Well, I believe it.
Yeah, so I actually wrote about it in this book called Retirement Ruse, which came out, believe it or not, less than a year ago. But that we were number 22, Mark, and only 12 months ago, and now we're at roughly 29. And the reason is because there's really no income planning for people's retirement plans. In other words, our systems, the best systems in the world, Mark, are consistently the Netherlands, Iceland, Israel, Norway, the European countries, because they're virtually all of them are all income based, they're all annuity based, all of them.
But why are they so far ahead of us? Great that they have those vehicles that you mentioned, but what makes them different than us? I mean, it's a free country. We've got all kinds of information.
Yeah, but it's the thing is that I'm a capitalist and a free market guy, but when it comes to retirement planning, you really need to have income. That's what people want in their old age, and and the thing is that, but the way these 401ks now are structured, I say try to get a stock or mutual fund to provide retirement income is like asking a fish to climb a tree. It's never going to happen. And if you look at really the best retirement systems, they're all based upon contractual guarantees. And so I've done the research throughout the world, and the thing is that this is why we're in the bottom, because a retirement plan is produce retirement income. And I've owned pension consulting businesses. I still do pension consulting today. And I own a registered investment advisory firm, and I'm not against the market at all. I'm all for it. But the thing is, for retirement, people want to have an income stream, and as a result, it's the statistics are not too heartening, Mark. Roughly about there's about 30.2 million people retiring between 2025 and 2030. Who are going to be hitting 65, and 60% of them, 67% of them only have Social Security. So it's a real major problem. So what we have in this country today is that if you're really rich, there's no retirement problem you're going to have, or if you're a government employee, they're all the defined benefit, which is a traditional annuity-based plan. There's really no problem with that. So really, if you're really rich, or if you're a government employee, you're going to be okay. But everyone else is they need to have more guidance than ever.
It's really a shame that that's the case, is because it's not that hard to give people guidance, but the guidance doesn't have to start when you're 55 or 60. The guidance needs to start when you're 15 or 20. And that, I think our problem is that we don't start letting people think about what money is and what it can do for you because it's so far away and it's not part of our system, is it?
No, and you know, and this is the thing. This is why I'm doing this book. It's going to be called Guaranteed Income too. Is that, and it's not just about retirement plan. It's really a behavioral um, uh, problem. In other words, is that I I've been doing this long enough time now, Mark, where I realize that a lot of rates of return, and we all want to have the best rates of return, but a lot of it is it's not rocket science. It's really it's a function of behaviors and discipline. In other words, if you learn how to save 15, 20% of your income, if you just do that,
Yeah.
a lot of your problems go away.
Yeah.
So so the big problem today is that in America, we instead of we don't even save. We throw everything into the market, and there's no structure to it. There's no strategy to it, and it's I call it, we suffer from the Stockholm syndrome,
Yeah.
and and the thing is that the research, actually, believe it or not, I got from Fidelity and Vanguard shows that actually even when people should be more proactive and seeing someone like a guy like you for options or option income, instead of being prudent and really taking positive action forward, people they're like deer in the headlights, Mark.
Yeah.
So I call it Stockholm syndrome. So even Mark is and and then we have a lot of these things about these target date funds, which are roughly 80% of all retirement funds now, which are I wrote a book about them, and I still I wrote this book, believe it or not, in 2012, and they're very complicated then, and I still don't understand them. So we have a lot of problems. We need to learn how to save versus invest. So I think you really have to save first, then you invest. That's just my opinion.
Well, I don't think you ever save your way to wealth. I think, that's the first step. But savings, just holding on to the money, you're going to lose, I believe it's 11% a year in, to inflation and buying power. So you've got to stay ahead of the curve. You can't just put your money under the mattress and hope it's going to be worth something when retire because it's not designed to be that. They inflate it away. So what happens, is I guess what happens is most people don't know about money, think you need to save, they get too afraid to invest in anything, and therefore they lose the opportunity of time and compounding, right?
They lose, and they have there's a tremendous lost opportunity cost, as you know,
Yeah.
and so yeah, you have to have somebody in the market just to keep up with inflation. So because that's really kind of the killer, as
Yeah.
you know, that's the B-1 bomber stealth tax is really inflation, and that's why I can't imagine a young family today. You know, I mean, I'm a single guy, and I go to the grocery store and I spend 150 bucks, 200 bucks, and really, you seem to get that much. So we need to be more proactive and invest in ourselves um, to really get ahead of the game. No, but the problem is that we don't save in this country, Mark. First of all,
Yeah.
somebody you look at, and I actually have the statistics on this from the Organization for Economic Development, that roughly, I think in Norway, people save as a percentage of income, maybe about 20% of their income. The US is down to 1.5%.
Amazing.
So a lot of it, I agree with you totally, but I'm saying a lot of the thing is really behavioral. We don't save instead
Yeah.
of instead of we're going to put it instead of saving first and then investing. And we just borrow and so now we have all this crazy stuff. I don't know if you've been keep up with this stuff, buy now, pay later stuff. Have you seen that?
It's an epidemic. Yeah, I've seen that.
I mean, can you imagine financing a pizza? I mean, isn't that stupid?
It's a house of cards at some point. You can't continue to build on debt and get ahead of the game because you've got that anchor weighing against you. So what do you tell people? Like, let's say you meet a 50-year-old guy that's got a family that just, he sent the kids off to school and now he's looking at his wife and, maybe he's like, well, maybe we're not prepared for retirement. What do you tell that person to start doing?
Well, again, first of all, I would say a lot of it's the discipline. It's just,
Yeah,
you can't keep spending more um, than what comes in. And if you keep spending more than what comes in, for any individual, a family or a small businessman, like you or I are, okay, we go out of business. So the only way you can get away with that is the government, okay,
yeah,
and the U.S. And the thing is, but that's going to come to an end. But so first of all, you want to have the fundamentals right. You want to have, I'm a blocking and tackling guy. That you should really have the proper you know insurance is in place, and wills and trusts like that. I've been doing this. I don't know how long you've been doing this, Mark, but I've been doing this for 40 years now, and I've
about
actually
the
had.
same.
It's sad, but I've actually had 63 clients who have passed.
Yeah.
You have that long longevity, and so I realized the value of good planning. So I think really the first thing is really just to you look at the whole thing is that to make sure that the plan works, whether they die or become disabled. So and then we build upon that.
So it's saving is really your big thing, and then protecting it sounds like is your next big thing.
Well, it's you don't. Yeah, saving it's that I'm just we have real fundamental problems in this country in the sense that I call what is called the asset management industrial complex. And I was friends with I remember the guy Jack Bogle who founded Vanguard.
Yeah.
Because of the books I've written, I actually became friends with him. And then and he liked the work I was doing in retirement income. But because you look at the best retirement systems, they're all annuity based. And I testify in court on this. And the and he really liked the research. But when um, I also knew a good friend of mine, Ted Benna. He's about 81, 82 now. Do you know who Ted Benna is?
No, I don't.
He's the guy who actually created the 401k.
Oh,
And I'm in a movie called The Baby Boomer Dilemma. I don't know if you've seen that.
I have not. Oh,
Okay, well, I'm in it with some of the top economists in the country, but anyway, it's about how to create lifetime income in retirement. And Ted is actually the guy who created the 401k. And the 401k, Mark, was really just meant to be like an ornament on a Christmas tree. Like the pension plan was supposed to be the core retirement system. Okay,
right.
so like Social Security. Okay, so that's really and so the 401k was just meant to be a like an ornament on the Christmas tree, and now it's really become the main event.
Yeah, it's gone from defined benefit to defined contribution.
Yeah,
Right?
and you
Yeah,
know, and
yeah.
and I tell people a new toaster from Walmart has more guarantees than a 401k.
So true. So true. And you're limited with the 401k. I mean, look, they're great for some people that don't do anything because a lot of times companies will at least do some matching. So you get some kind of return. And usually if you throw enough money at something over time, compounded interest is going to bail you out. But there's not a lot of choices, at least in the 401ks that I used to be involved with. And there's a lot better ways to spend your money, but at least it's something, right?
Yeah, you got to discipline your save,
Yeah.
and the thing is that if you want to buy equities or things like that, you should have you need to have capital,
Yeah.
and the thing is that you and I are not bankers, so we can't create money out of thin air like they can.
Yeah.
And the irony of the whole thing is that you know, people think I look like I have five heads sometimes, but you know who the biggest purchasers are, Mark, of guaranteed insurance products and annuities
I
in this
don't.
country? No? Do you have any idea?
Pension funds? I don't know.
Actually, banks.
Banks, huh? Yeah.
Banks, yeah, banks, and that's how I wrote this first book. This was kind of called the Pirates. I don't know if you can see that or the Pirates of Manhattan, but that was the book. This is the book. It's still I wrote it 17 years ago, and I explained that the banks. i.e. JP Morgan Chase, or this is all public information, Wells Fargo, Citigroup, you name it. Okay. All the major banks, they all invest billions of dollars in of their tier one capital into annuities and high cash value life insurance,
Yeah.
known as BOLI. I don't know if you're familiar with that at all.
Yeah, no, I've heard about that. Yeah.
Yeah. So this is kind of it was a I stumbled upon it years ago, and I'm still sticking to this. And that so what would kind of amaze me, Mark, is that I'm seeing, because we're talking about retirement income, but all these major banks were buying billions, literally billions of life insurance. Really, a lot of it to fund the have a stable balance sheet, but more importantly, to fund the executive pension plans.
Yeah. Wow. Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you could do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more. Well, let's have a little fun. Let's shift into a different gear. Let's have a debate. And there's been recently some news out of Washington about the government deciding, I think it's through an executive order, to open up pension plans to the ability to invest in crypto and other events, private equity, and things like that. So I'll take whatever side you want to take, you don't want to take, and we'll have a debate. How about that?
All right. Well, I'm not for. I voted for the orange-haired man, but I don't agree with this. So whatever you want to take, Marcus, I'll be happy to. I'll be. I don't know. I'm against crypto and private equity in 401ks.
Okay, so you'll take the stance of you're against crypto and private equity, and especially in 401ks. And I'll take the stance that it's going to be beneficial, and they're not just pulling it out of thin air. So let's talk about that. Doesn't that allow, okay? So let's lay the foundation. I'll lay this foundation. Crypto, and I don't believe in all of them, but I do believe in Bitcoin. But crypto is a new technology. So to not embrace a new technology, doesn't that hold things back? And that's almost like saying you shouldn't invest in ETFs because that's a new technology. That was a new kind of investment some years ago. And so to say, well, we don't want ETFs because they're risky. Maybe we don't know enough to say they're risky or not, but isn't it a similar thing that when we have a technological innovation, that we should allow our markets to at least have the choice to be investing in them? What do you think?
Point well taken. I'm all for technology. That's probably one of my big, even personally, technology, even my own business, other than overhead, labor, my technology, I'm a very big believer in it. But on the other hand, I'm like in ETFs, I'm for ETFs. I'm not against, I'm an indexing guy, but and I've read an awful lot on this, and my tech guy would probably be against me, but when I look at crypto, I kind of look at what happens if the electricity goes out, and then I was also think of the Dutch with tulip mania, and I'm not saying that we're not going to have some type of cryptos. We already have digital currency because the Federal Reserve can create money out of thin air now with essentially checkbook entry. So I just don't know, and it's so bloody volatile. I mean, the volatility is, and where I'm specializing is really for people in their older ages. Well, I'm trying to give them peace of mind versus having more volatility, and so that's where I'm kind of at. I mean, this, and I don't know. Have they ever found out who this guy, Mahoshi Satori, the guy who supposedly created Bitcoin? Have they ever found him or her, or it or
Satoshi Nakamoto is the founder or creator of that, and it's largely believed that he's not no longer with us. He might be related, or he might actually be Hal Finney, who died of ALS 2011, 2012, something like that. After in theory creating this digital asset. So let me address a couple of the things that you mentioned that I've heard many, many times in this debate of crypto. First of all, I believe it's a new technology. Blockchain is an amazing, cool technology. It's transparent, so everybody can see it. The issue is when you have my dad used to say, if you have a human being, any guy sitting next to a pile of money, they're going to spend it. And so in every crypto, except for Bitcoin, there is a limited supply. There's an unlimited supply, just like there is at the Fed. And we can see what the benefits or the detriments are of having fiat currency printed out of thin air. It doesn't have real backing at some point. So you could say it's got the full faith and credit, but so did with the Weimar Republic, and so did the tulip mania that you mentioned, and so has every fiat currency. They've all, just declined and disintegrated. In Bitcoin's case, it has scarcity. There's only 21 million Bitcoin that will ever be made, and there are only 3.125 Bitcoin mined every 10 minutes. So it's a different kind of a digital currency than, say, the Fed, where they just say, hey, bank, here's a bunch of billions of dollars, go loan it out. Because that anytime you get something created out of nothing, it becomes something worth less and then eventually worthless. So that's my biggest thing. And yes, Satoshi Nakamoto might have created it, but Eli Whitney created the steam engine or the cotton gin, and they're no
that
longer,
went, you know.
and we have the benefit of that. So I'm not sure that not embracing it. I mean, I hear the fact that you say it's volatile. It's also the most incredibly performing asset in the history of humankind. There's never been another asset that's performed as well as Bitcoin. So to say that we shouldn't have it in there because of volatility, I'm not sure that's the right argument. And the last part is, if that's the argument, people have been saying for years, well, let's put money in bonds because that's backed by the full faith and credit of the government. But bonds have declined 50, 60% in the last 5 years because of the fiat inflation, because of creating money out of thin air. So isn't it time for maybe something else to be injected into these pension plans? Because frankly, they're all actuarialized at an 8% rate, and we're really not really making 8% real rates anymore.
No, it's BS, and I
Yeah,
actually have two, point well taken, Mark. And I'm not against it. I'm just saying that I've seen more disasters with cryptos.
absolutely. Could absolutely happen. Sure.
I have seen a couple of disasters, Mark, like you wouldn't believe. I've
Me
saw
too.
people lose like $1 million in this shit,
Me too. I know. I know.
So I'm not against it. I'm saying as a portion of someone's portfolio, 5-10%. No, I'm not saying that at all. I'm
There you
just
go.
saying that retirement income. You want something which has a contractual guarantee,
Yes.
and that's based retirement income. And so I'm not against it. But that's as I say about the tulips too. The tulips are people were going selling the whole fortunes in tulips, and with the 1600s in the Netherlands. So I don't know, where it's going to go, but I think we just need to have some balance. And also, I just the recklessness too, as that with Trump's executive order, and including private equity and hedge funds is now you run a I guess you do run a hedge fund. I'm not against it, but I'm saying as a people can't understand their mutual funds or ETF now or an index fund. They don't even understand how are they going to understand private equity or private credit? You
Great
know,
point. Yeah.
and I'm and the whole thing is and the carnage, the unequivocal carnage with private equity you will see in the next book.
Yeah.
It's just people don't have a clue. And the people who are the billionaires, the Blackstones, the Carlyle groups, the TPGs, the whole thing like that, they don't realize the bankruptcies. You know how many major bankruptcies that have been in private equity since 2020, Mark?
I'd love to hear it.
Over 500.
Wow.
People say,
Yeah.
oh yeah, well, I say, you ever heard of these companies called like Toys R Us or Neiman Marcus or Caesars Entertainment? or Chrysler Motors. These are all leveraged buyouts.
Wow.
And the thing is that uh, so the thing is that there was another one actually called Avaya. They're not in North Carolina anymore. They were in North Carolina, but New Jersey. But and so you're seeing a lot of these private equity backed companies with the private credit.
Yeah.
This going into the toilet,
Yeah.
and
Great
no one's
point.
put it together. But that's why I'm doing because no one's done it.
Yeah, I go back and forth between, people don't know what's in their 401k anyway. They don't know what's in these pension funds anyway. They don't know what they're investing in. They're investing in bonds, which I just mentioned are supposed to be the safest thing, and they're down 50% while you get your 4% yield. Um, so I'm not sure, I'm not sure what the right answer is. I just enjoyed the debate because it's good for people to hear both sides.
Yep.
But at least I don't know if they know what's going in their funds anyway. So opening up to private equity and cryptocurrency and other things like that, I'm not sure whether it's good or bad. But you bring up some great points. We want to make sure that our funds are stable and we don't have volatility and crashes and things like that going into retirement for sure.
Yeah, because this is the thing. And this is the thing, and I've got this backed up, and I'm getting into another book which I've had and kind of in the ice box. But the one of the things which I learned, Mark, is that the private equity guys, and a lot of them, I'm not saying all of them, but you know where they make their money, Mark? On the fees.
Oh, of
It's all
course.
about the
Of course.
fees,
Sure.
And so when you look at the structure of a private equity deal or a leverage buyout, they're creating an annuity income stream for themselves.
Yeah.
And if you look at it, it's really easy to do the math. But if you get someone to commit $1 billion to you, and you're running a private equity firm, and you're getting 2% management fee, so what do you get? You get 20 million a year just for rolling out of bed,
Just for waking up. Yeah.
just for waking up. And the thing is that so. And then if you look at the investment banking fees or the carried interest of the private equity guys, I'm just dumbfounded. And actually, one of the things which I kind of couldn't believe, but I have a question for you. So say now you're in Florida, or it doesn't matter what state you're in, let's say,
Yeah.
and say you're and you raise $100 million for the state of Florida or New Hampshire, where I'm in. How much does the private equity firm get paid on when they, now they don't take all that 100 million at once. They take it in dribs and drabs.
Yeah.
As how much do you think they get paid on? Do they get paid on the whole 100 million or just part of it?
I bet they get paid on all of it, and they get
Yeah. So
a
even if the
commission, a
money is
placement
not
fee.
deployed, which I couldn't believe, it's called committed capital.
Yeah.
And I started looking at these, and there's a great guy, Ted Siddell down in Boca Raton. He showed it to me, and then I discovered is that even if they raise $100 million fund, even if they don't take the money, and they're still getting paid the
Yeah.
2% on that, even if the money's not being deployed.
Yeah. It's amazing. Well, let's see, Barry. You got a lot of experience. You've written a lot of books. You got a lot of knowledge. How can people get a little bit more of Barry Dyke?
Well, first of all, yeah, just go to the my website, go to barryjamesdyke.com, buy some books, get educated first of all. And
That's the main thing. If we get nothing else out of this podcast, it's you got to get educated. So keep going. Sorry about the interruption. Yeah.
you got to get educated, because it wasn't, and you have to understand, how banks work. I think, when I really started understanding the mechanics of banking, Mark, that's how I found out I could be more value to other people.
Yeah, for sure.
And the thing is that a bank can create money out of thin air, but they can repossess your assets, even on something that they create out of thin air. And so I think really the thing you really want to do is grounded first of all. I mean, I call it my 5 F's, if you will. My faith is the most important thing in my life. I'll tell it to anybody. I'm a Christian, so I believe in higher power. Number 2 is, the second, my strongest belief is my family. We I don't know what your family is, but I do everything for my family. The third is my friends. I couldn't do anything without meeting people like yourself or people, friends within the industry and fans and so forth. And no one does anything on their own. The next thing is physical fitness. I believe in physical. You got to be physically fit, and I think the way that our financials is going right now, you're gonna have to be more physically fit in the days ahead. And then last thing is really kind of finances. So those are my 5S. So my
Nice.
faith, my family, my friends, physical fitness, and then finance. Does that make
I love
sense?
that. That's great. That's really good.
Because I think if you don't, you're going to have a good spiritual core as things get tougher in the days ahead, and they're getting tough.
They are. They are. And I think they're going to get easier and tougher ahead like they always have. But there's some interesting times ahead for sure. So Barry, thank you so much for being a part of the Wealth Architect podcast. I loved our chat. I'm sure we could go on for another couple hours talking about the importance of income and in retirement. But let's let people go to your website, get some books, educate themselves, and move to the next step. And those of you who are listening and watching the Wealth Architect podcast, remember what I always say. Never give up your power in your health, your wealth, or your time. And I'll see you next time on the Wealth Architect podcast. Take care. You've been listening to the Wealth Architect podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.